The stock hit $150, then it crashed to $43, then it ripped back to $85, all in under 18 months, on the exact same business. No acquisition, no scandal, no pivot. Just a Mediterranean restaurant chain that sells grain bowls and pita and charges you $17 for the privilege. And Wall Street cannot decide if that's worth $4 billion or $14 billion. If that sounds like a lot of drama for a lunchtime salad, you're in the right place. Welcome to Ticker Talk. One stock, 5 minutes, no jargon. Let's go. What they do. Cava is a Mediterranean fast casual restaurant chain. Think Chipotle, but with hummus, harissa, and falafel instead of guacamole and carnitas. The format is identical. Walk down a line, build your bowl or pita, pay a mid-range price, out in 5 minutes. The food is customizable, the brand leans health-conscious, and the average customer skews younger and more affluent than a typical fast food chain. They went public in June 2023, and the market immediately started asking, is this the next Chipotle? Here's what they actually are right now. 439 restaurants across 28 US states, a grocery business selling dips and spreads in retail stores, and a long-term ambition to reach 1,000 locations by 2032. The numbers. FY 2025 was a milestone year. Revenue crossed $1 billion for the first time, $1.17 billion, up 22.5%. They opened 72 net new restaurants. The unit economics are genuinely impressive. Each restaurant generates around $2.9 to $3 million in average annual revenue. Restaurant-level profit margin is 24.4%. Nearly a quarter of every dollar you spend on your bowl stays in the restaurant before overhead. That is Chipotle-grade margin for a company 1/10 Chipotle's size. Net income for the full year, $63.7 million. Profitable and growing. 2026 guidance, 74 to 76 new restaurants, same restaurant sales growth of 3 to 5%, adjusted EBITDA of $176 to $184 million. But here's where it gets complicated. That $1.17 billion in revenue supports a market cap of roughly $9.7 billion. The stock trades at 147 times earnings. The restaurant industry average is 22 times. Chipotle trades at 35 times. Cava is priced for a future that hasn't happened yet. The bull case. The market is buying the runway, not the current business, and the runway is real. 439 locations, 1,000 by 2032. If Cava executes and the unit economics hold, this is not a restaurant stock anymore. It is a platform. Every new location is low capital to open, generates strong margins from day one, and adds to a brand flywheel that makes the next location easier to fill. The Mediterranean food trend is not a fad. The shift toward fresh, protein-forward, customizable food has been running for a decade, and Cava is the only national chain that has cracked the format at scale. There is no Mediterranean Chipotle except Cava. The digital revenue mix, 37.9% of sales through digital channels, means a direct relationship with customers that compounds over time. That data is worth something beyond the individual transaction. The bear case. The valuation is the bear case. There is almost no other way to say it. Cava trades at 147 times earnings. Chipotle, its closest comp, its aspirational ceiling, trades at 35 times. You are paying a 320% premium for the right to own the company that wants to become Chipotle versus just owning Chipotle. The growth is already slowing. Same restaurant sales growth was 13.4% in 2024. In 2025, it dropped to 4%. Management guided 3 to 5% for 2026. That deceleration is exactly what high multiple stocks cannot afford. One miss, and this stock revisits the low 40s. It already happened once, all-time high of $150 in December 2024. By November 2025, it had crashed to $43, a 71% drawdown after a single quarter of softer same-store sales. Beta of 2.4. This is not a stock for the faint-hearted. Here's where I land. Cava is a genuinely exceptional business. The product works, the unit economics are real, the runway is long. There is a version of 2032 where this stock looks cheap at today's price. The problem is that the stock already knows all of that. There is very little margin of safety. One bad quarter, one hint that the same store sales deceleration is structural and the multiple corrects violently. Watch the same restaurant sales number every quarter. If it holds at 4 to 5% while new openings stay on pace, earnings will grow into the multiple. If it slips below 3%, the re-rating will be brutal. You're not buying a cheap stock, you're making a bet on a 10-year growth story at a price that requires the story to go exactly right. Not financial advice. Do your own research, all figures from Cava Group public SEC filings. One stock, 5 minutes, no jargon. See you next week.